There is an opportunity. If that gold is in Fort Knox, they are going to say, we're raising the price of gold, just like they jacked it up 70% after they stole it from the people back in 1933. They gave them like $20.80 cents or something an ounce. And as soon as they got it all, they increased the price to $35 an ounce. If they increase the price of gold 70%, it's $5,000 an ounce. They're going to say, we have all this gold and now we just took care of our debts, and don't worry about it. They're going to do something. Gold didn't have a great day today. It was down some $39. But, this isn't news to us. We kept saying how many times there's got to be a correction. Nothing goes straight up or straight down. We still remain very bullish on gold because of the socioeconomic and geopolitical things that are going on out there.
Gold prices fell sharply on Tuesday afternoon in London, dropping $60 per ounce to a one-week low, down 2.2% from Monday's fresh all-time high. The decline came as government bond prices rose, silver and platinum group metals weakened, and global stock markets extended their losses amid worsening economic data. Last week's reports indicated growing stagflation concerns in the U.S., leading to increased investment inflows into gold exchange-traded funds. However, the Chicago Fed's National Activity Index edged lower for the fifth time in 6 months, signaling ongoing economic instability. Gerald Celente, author of the Trends Journal, notes that this market correction was expected following gold's rapid rise. Despite the recent dip, he maintains a bullish long-term outlook, pointing to geopolitical and economic uncertainties as key drivers. Additionally, former President Trump's upcoming tariffs on China and Mexico, set to take effect on March 4th, add to inflationary pressures and market volatility. Fears that Trump's tariff proposals will trigger a major global trade war have helped gold scale record highs several times and gain about 11% this year. The U.S. economic data cycle intensifies later this week, with key inflation figures, including the Personal Consumption Expenditures Price Index, scheduled for release on Friday. These reports could further influence gold's trajectory and broader market sentiment. Celente also suggests that if the U.S. government were to revalue gold, similar to the 1933 price hike of 70% following gold confiscation, the metal's price could theoretically surge to $5,000 per ounce. Such a move could be a strategic tool to offset the national debt, reinforcing gold's role in financial stability. While the U.S. Treasury dismisses the possibility of revaluation, speculation is growing. Analysts suggest that U.S. gold reserves, estimated at 261.6 million troy ounces and valued at approximately $750 billion at current market rates, could be adjusted to reflect modern pricing. If such a policy shift were to occur, it could have significant implications for global markets and the broader economy. With rising inflation fears, monetary policy uncertainties, and ongoing geopolitical tensions, gold remains a critical asset to watch in the coming months. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
There is an opportunity. If that gold is in Fort Knox, they are going to say, we're raising the price of gold, just like they jacked it up 70% after they stole it from the people back in 1933. They gave them like $20.80 cents or some cents an ounce. And as soon as they got it all, they increased the price to $35 an ounce. If they increase the price of gold 70%, it's $5,000 an ounce. They're going to say, we have all this gold and now we just took care of our debt. So don't worry about it. Yeah. They're going to do something. So I'm telling you, we're trying to give you everything we can. And it goes back to gold. And when things get wild, gold prices are going to go up. Nothing goes straight up or straight down. There could be another $200 down on gold. Easily. When it flew up this fast, this high. But long term, we're bullish and we don't give financial advice. We give trend forecasts. Gold didn't have a great day today. It was down some $39. But, this isn't news to us. We kept saying how many times there's got to be a correction. Nothing goes straight up or straight down. We still remain very bullish on gold because of the socioeconomic and geopolitical things that are going on out there. And, of course, today, one of the big news is that Trump says those tariffs, I'm going to put them on. I think it was March 4th on China and Mexico. So, that has a lot of uncertainty, and one of those is inflation. So, going on to what's going on, you take a look at the markets today. The S&P fell 4 times in a row. Why? They say that the traders, the gamblers, they're worried about economic growth and the tariffs, the global trade issue. Let's see. NASDAQ dropped 1.35%. NVIDIA, boop, down 2.8%. Tomorrow, everybody's waiting. What's going to happen with NVIDIA when they release their earnings report for last quarter? And again, the whole DeepSeek is now out of the news. And as we keep saying, China's going to lead this trend in AI. Love it, hate it. And again, I hate the whole thing. But and I'd rather the United States lead it than China, but we call it like it is. So that's going to be a big thing, but we're still forecasting a dot-com bust. There's a lot of uncertainty in the markets in this new realm here. Under Trump, it was very positive in the beginning when he got elected. It hasn't looked so good now. The market took a leg lower after the most recent consumer confidence survey came in much weaker than economic estimates. This follows a series of disappointing releases. This is CNBC. Last week, including lackluster manufacturing and retail sales numbers.
Trump escalated trade tensions on Tuesday by launching an investigation into potential new tariffs on copper imports, aiming to boost domestic production of a metal essential for electric vehicles, military hardware, the power grid, and various consumer goods. This move adds to concerns over global trade norms and fuels uncertainty in financial markets. U.S. consumer confidence declined at its sharpest rate in 3.5 years in February, reflecting growing anxiety over these policies' potential negative economic impact. At the same time, 12-month inflation expectations surged, increasing concerns that persistent inflation could force the Federal Reserve to maintain higher interest rates for longer. Since higher rates diminish the appeal of non-yielding assets like gold, investors are closely watching the upcoming U.S. Personal Consumption Expenditures Report, set for release on Friday, which serves as the Fed's preferred inflation gauge and could provide insight into future monetary policy decisions. Gerald Celente warns that leading economic indicators continue to weaken, with consumer confidence levels now at their lowest point since the peak of the COVID-19 crisis. Rising inflation, trade uncertainty, and deteriorating economic sentiment heighten the risk of another significant market downturn comparable to the dot-com crash. As market conditions remain volatile, the coming days will be crucial in determining the broader financial outlook. Let's get back to the interview.
There may be a mineral deal with Ukraine. That's the latest breaking news. So I got to hand it to Trump. If Biden was in office, he would have only ramped up this Ukraine war. If Trump was in office when the Ukraine war began, I don't believe he would have sent all these weapons. Going back to the markets and the dot-com bust, they're not talking about this. Tesla shares, by the way, today, they sank 8% and down 25%, the stocks of Tesla this year. And you know what? The Dow is down 1.5%. So there's a lot of ifs here. Remember, one of your top trends, and I've been at this 45 years, is a wild card. We've never said this before. The joke is wild. Look what's going on. This is real. This dot-com overload in the AI sector is big. Tomorrow's going to tell a lot. And again, in your Trends Journal, and Gregory Mannarino nailed it before the data came out today. One of his articles in this week's Trends Journal is the U.S. economy is shutting down rapidly. Expect widespread job losses with much higher inflation. An article came out showing how the rich, the top 10%, are driving the retail sector. Wrote about it extensively in this week's Trends Journal. And Moody's Analytics says the top 10% of earners now account for 49% of all spending, up from 36% 3 decades ago. And these 10 percenters, they account, you ready for this? 1/3 of the U.S. gross domestic product. And that goes into our article in much more detail in this week's Trends Journal. Leading U.S. economic indicators weakened as the year began. This is serious. Again, this is Slavelandia. It's a whole new game. The big zone everything. And again, you see with Trump, again, I say what I say things only with the facts. You got a billionaire club in there, all right? As I say, if you're not a billionaire, shut your fucking mouth, you can't say anything. Here's the data. The middle class is shrinking, the rich are getting richer, and they're running the show. So, Manarino nailed this, and we're telling you that a dot-com bust 2.0 is very, very likely. And tomorrow's going to tell a big, big story. So going on to your other top trends in your trends journal, happy days are not here again. After being a bit upbeat prior to following the election of President Donald Trump, consumer confidence in February hit its lowest level. You ready? In its lowest level since the peak of the COVID war, when everybody was freaking the fuck out, when they locked everything down.
As economic uncertainty deepens, investors continue to weigh the impact of trade tensions, inflationary pressures, and shifting monetary policies. While gold has seen a sharp pullback, its long-term resilience remains evident amid growing concerns over financial stability. The possibility of policy shifts, including potential revaluations or trade restrictions, adds another layer of complexity to the global market outlook. Given the ongoing volatility, will gold remain a preferred hedge, or will evolving economic conditions shift investor sentiment toward alternative assets? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.